Look at this number, $100,000 in debt. For most people watching right now, that number triggers something. Maybe it's anxiety, maybe it's shame, maybe it's that low-grade hum of dread you carry around every time you check your bank statement. $100,000 in debt feels like a chain around your ankle, like something you need to escape from as fast as humanly possible. But here's what I want you to sit with for the next few minutes. To a billionaire, that same number, that's a weapon. Not a burden, not a liability they're scrambling to pay off. A weapon, a precisely engineered tool that in a high inflationary environment becomes more powerful every single month it exists. Because as inflation rises, the real value of that debt shrinks. You eventually pay it back in cheaper dollars, while the assets you purchased with it continue to climb. The debt disappears in real terms, the asset remains. And by the time we're done today, you're going to know exactly how to run the real rate test on every debt you carry and determine with a single calculation whether your liabilities are working for you or quietly bleeding you dry. That is not a loophole. That is not a trick. That is structural financial architecture, and it's been operating in plain sight for decades while most people were told to do the opposite. Pay off your debts, avoid borrowing, stay safe. I'm Dr. Ben, and at WealthForge, we don't follow the market, we design the moat. In a world of followers, we are the architects of our own freedom. Today, we're going to cover 3 things that most financial channels will never put together in a single video. First, the exact mathematics of how inflation is destroying your debt in real time right now, whether you planned it or not. Second, the precise borrowing playbook the ultra-wealthy have been running across every inflationary cycle for the past century. And third, a step-by-step audit framework you can apply to your own balance sheet this week. Stay with me. This one shifts how you see money permanently. Let me start with the math, because this is where most financial content fails you. Everyone talks in abstractions. Let's get concrete. You borrow $100,000 in 2023 at a fixed rate of 5%. Let's say it's against a property or a portfolio. You're paying $5,000 a year in interest. Now inflation runs at 7% over the next 3 years. That's not a hypothetical. That's close to what's been happening. Here's what actually occurs to that debt. After year 1, the real value of that $100,000 principal in inflation-adjusted terms is now roughly $93,000. Year 2, it's closer to $86,000. By year 3, you are effectively carrying the real-world burden of about $80,000 of debt, while still paying interest calculated on the original $100,000 figure. The gap between what the bank thinks you owe and what that debt actually costs you in purchasing power terms, that gap is your profit. That gap is the mechanism. Economists call this concept inflation arbitrage, but let's call it what it actually is. The systematic destruction of your debt in real terms while you do almost nothing except hold the asset the debt purchased. Now, here's the part nobody tells you. The asset on the other side of that equation, the real estate, the business, the energy infrastructure, the commodity position, that asset is denominated in the currency that's losing purchasing power. So while your $100,000 debt is shrinking in real value, your asset is being repriced upward in the same currency that's losing purchasing power. You win on both sides simultaneously. This is why the wealthiest families in the world do not fear debt. They fear not using it. The mechanism is real, the math is documented, and it's been running quietly in every inflationary cycle for a century. Coming up next, exactly how the ultra-wealthy access this structure without selling a single asset. Now let's talk about who actually does this, because it's not abstract. When you look at how ultra-high net worth individuals actually manage their finances, the picture that emerges is almost the opposite of what most of us were taught. Most of us were taught a simple equation: earn money, save money, eventually stop owing money. The wealthy operate on a completely different architecture. They don't sell their appreciating assets to generate cash. Selling an asset triggers a tax event. If you've built a concentrated position in real estate or a business over 20 years, selling means handing a significant portion of that gain to the authority immediately. The wealthy understood long ago that selling is often the worst possible move. Instead, they borrow against those assets. They take lines of credit against their investment portfolios, against their real estate, against their ownership stakes in private businesses. The loan proceeds come in as cash, and loan proceeds are not income. They are not taxable. You receive liquidity without triggering a tax event, and the asset continues to compound in the background. This is the architecture behind what financial strategists have called the buy, borrow, die framework, though in 2026's environment, that framework has evolved and sharpened considerably. Here's the updated version. You buy a real asset, something with intrinsic productive value or scarcity, real estate in a corridor with genuine demand pressure, energy infrastructure, agricultural land with water rights, businesses with pricing power. You let that asset appreciate and in many cases generate cash flow. Then you borrow against it at fixed rates, ideally rates that when adjusted for projected inflation are actually negative in real terms. If inflation is running at 6% and your borrowing cost is 4%, your real interest rate is negative 2%. The bank is in effect paying you to borrow their money when you account for purchasing power erosion. You use those loan proceeds either to fund your lifestyle, removing any need to liquidate positions, or you deploy them into additional assets, compounding the structure further. The critical point I need you to absorb right now is this. In a high inflationary environment, fixed rate debt is a hedge, not a risk, a hedge. Because you locked in the cost of borrowing before the currency debasement accelerated, and now every month that passes, that debt becomes cheaper in real terms without you doing anything. The billionaire borrowing equation. Buy a real asset, borrow against it at fixed rates, use proceeds without selling, let inflation erase the real cost of debt, and you repeat. Let me stop and reset for a moment, because everything we've covered so far, the inflation arbitrage math, the borrowing playbook, all of it hinges on one thing. You must get this right. Without it, the entire architecture collapses, and this is where most people make the critical error. Not all debt is a weapon. Some debt is a trap, and the difference between the two is not the amount, it's the structure. The single most important variable is whether your debt is fixed or variable rate. This cannot be overstated, especially in the current environment. Variable rate debt means your interest cost fluctuates with central bank policy.
When rates rise, as they did aggressively through 2022 and 2023, your debt service cost rises with them. Variable rate debt in a volatile rate environment is not a hedge, it is exposure. It transforms what could be a strategic asset into a structural liability that bleeds you during exactly the moments when you most need stability. Fixed rate debt is the opposite. You lock in a cost. That cost does not move. As inflation erodes the real value of the principal, your fixed payment stays constant in nominal terms while shrinking in real terms. The structure rewards you for simply holding. Here is the tool. I call it the real rate test. Take your nominal rate, subtract projected inflation. That number is your real interest rate. Positive, you're paying real value to hold that debt. 0, break even. Negative, the debt is subsidized by currency debasement. You are being paid in real terms to be in debt. In a high inflation environment, fixed rate debt at below inflation borrowing costs produces a negative real interest rate. That is the target zone for architects. The bank is giving you a tool that loses value in their hands and gains value in yours. That is the entire game. Beyond the fixed versus variable distinction, there are specific categories of debt that historically performed best as inflation hedges. Long-duration fixed-rate mortgage debt against income-producing real estate sits at the top of that list. The property generates cash flow that can be raised in line with inflation. The rent goes up, while the debt service cost stays flat in nominal terms. The spread between rising income and fixed debt cost widens every year inflation persists. That spread is engineered profit. Fixed-rate business acquisition debt works on the same principle, provided the underlying business has pricing power. A business that can raise its prices as input costs rise is not just surviving inflation, it is transmitting inflation onto its customers, while the fixed-rate debt used to acquire it quietly shrinks in real value. Now let's talk about the asset side of this equation, because the debt is only half the architecture. The debt is the mechanism, the asset is what makes it work, and not all assets are created equal in an inflationary cycle. The wrong asset on the other side of that debt destroys the strategy entirely. What you want are assets that either store value in real terms, generate cash flow that can rise with inflation, or benefit directly from the conditions driving the currency debasement. Let me walk through the most relevant categories right now. Hard commodities, physical things the world requires in finite supply. Energy, agricultural land, industrial metals, water infrastructure. These assets tend to be repriced in the currency that's inflating, which means their nominal value rises as the currency weakens. If you hold these assets and the debt used to acquire them is fixed rate, you benefit from the asset appreciation without the debt cost rising. Energy infrastructure specifically deserves attention in the current landscape. The global energy transition is creating extraordinary demand pressure across multiple vectors simultaneously. Fossil fossil fuel infrastructure, renewable build-out, grid stabilization, storage. Infrastructure assets in the energy corridor typically generate contracted cash flows, which means predictable income, rising pricing power, and hard asset backing. This is the kind of position that can service debt and appreciate simultaneously. Cash-flowing private businesses, particularly those in sectors with structural pricing power, consumer staples, essential services, logistics. These businesses can raise prices as their input costs rise, meaning their revenue is effectively inflation-indexed while the debt used to acquire them remains fixed. The spread between inflating revenue and fixed debt cost is pure constructed margin. If this framework is shifting how you think about money, subscribe now. Every video on this channel is a new layer of the architecture. You don't want to miss what comes next. Scarce digital assets, and I use that phrase deliberately, not speculative instruments, not meme tokens designed to transfer wealth from retail participants to early holders. Architecturally sound digital scarcity. Assets where the supply mechanics create genuine scarcity properties that function similarly to commodity stores of value in an inflationary environment. The allocation here should be sized in proportion to your overall architecture. It is a component, not the foundation. But here is the critical warning most people skip past, because choosing the wrong asset to pair with that debt doesn't just reduce your returns, it can erase everything the debt architecture was supposed to build. The unifying principle is this: you are matching liabilities denominated in a depreciating currency with assets that either produce cash flows rising with that depreciation or store value in real terms independent of it. The debt shrinks, the asset holds or grows. The gap between them is constructed wealth. And now we need to talk about how to execute this without blowing up the entire structure. I want to acknowledge something before I give you the execution steps. Most of us grew up in households where debt was never discussed as a tool. It was discussed as a failure, a source of stress at the dinner table, arguments behind closed doors, a thing that happened to people who couldn't manage their money properly. Unlearning that conditioning, truly unlearning it, is genuinely difficult, and I'm not going to gloss over that by just handing you a checklist. What I want you to hold on to is this: understanding the math is not the same as recklessness. The architects we've been studying didn't abandon discipline, they redirected it. Discipline toward structure, discipline toward coverage ratios, discipline toward holding through volatility rather than panic selling. The same intentionality, just aimed at a different target. With that said, here is how to begin. Start with a complete inventory of your current liabilities. Every debt you carry: credit cards, personal loans, mortgage debt, business debt, investment lines. For each one, note the interest rate and whether it is fixed or variable. Now, apply the real rate test to each fixed rate instrument. What is your nominal rate? What is the current trailing inflation rate in your economy? Subtract one from the other. If you are carrying fixed rate debt at a real rate below zero, congratulations, you are already benefiting from this mechanism. Whether you knew it or not, if you're carrying high rate consumer debt, credit card balances, personal loans at above inflation rates, this is where the work begins. High rate consumer debt is not a weapon, it is the trap. It must be addressed first, either by elimination or by conversion. The objective is to remove debt that is costing you in real terms before you think about using debt strategically. Once your liability structure is cleaned up, the second question becomes: what is the most capital-efficient way to access fixed-rate debt for strategic deployment? Depending on where you sit financially, this might look like refinancing existing property into long-term fixed mortgages to extract equity at fixed rates.
It might look like establishing a securities-backed line of credit against an investment portfolio. It might look like structuring the financing of a business acquisition to be predominantly fixed rate rather than floating. The third step is to match that debt precisely against assets in the categories we discussed. The math on this matters. You need to model out your debt service coverage. How much cash flow or liquidity do you need available at any given point to service the debt without being forced to liquidate in a down market? This is the safety margin, and it is non-negotiable. I want to be very direct with you about what happens when this goes wrong. Over-leverage, forced sell, distressed exit, position wiped. The same mechanism that makes fixed-rate debt a compounding tool can become catastrophic if the asset declines significantly, if your cash flow dries up, or if a liquidity crunch forces a margin call. The strategy requires a cash reserve that feels uncomfortably large until the moment you need it. Borrow at a level where even a severe disruption doesn't threaten your ability to hold.
The wealthiest practitioners of this strategy do not use maximum available leverage. They use strategic leverage, the amount that optimizes the inflation arbitrage benefit while maintaining the stability required to survive volatility without forced liquidation. Let me bring this back to the core principle. For most of your life, you've been handed a mental model that says debt is shame, that owing money is weakness, that the goal is to be debt-free as quickly as possible, because debt is a burden that good, responsible people eliminate. That model was built by people who benefit from your fear of debt. Because if you never borrow strategically, you never access the leverage that accelerates wealth creation. You stay in the accumulation lane, saving, working, hoping the market cooperates, while others use structured debt as a compounding engine. Here is what the two worlds actually look like side by side. In one world, you spend your productive years paying off debt as fast as possible, eliminating liabilities, building slowly, hoping wages keep up with inflation. In the other, you structure debt deliberately against real assets, let inflation destroy the real cost of what you borrowed, and use the gap between a depreciating liability and an appreciating asset to compound your position every single year. Both people worked just as hard. One of them understood the architecture. The other followed the conventional wisdom, and the conventional wisdom was never designed to make them wealthy. The bank lends you currency. Inflation destroys its value. You hold a real asset repriced in the same depreciating currency. The debt disappears, the asset remains. That is not a conspiracy, that is arithmetic, and the architects who understand it are quietly compounding on the other side of your fear. At Wealth Forge, we don't follow the market, we design the moat. This is what designing the moat actually looks like. Not picking stocks, not timing cycles, not hoping the economy cooperates. Structuring your liabilities to benefit from the very monetary conditions that erode everyone else's purchasing power. Building positions that compound through inflation rather than being destroyed by it. Your first move is the audit. Know exactly what you owe, at what rate, and whether that rate is fixed. Run the real rate test on every instrument. Identify what's costing you and what's working for you. Then begin the process of restructuring toward a balance sheet where your liabilities are tools rather than burdens. The architects among you already see it. You already understand that the fear most people feel when they look at a debt balance is the moat that keeps them from building wealth on the scale that's actually available to them. We are not the followers. We are the ones who design the structure that makes following unnecessary. I'm Dr. Ben. This is Wealth Forge, and if this shifted something for you today, hit subscribe and share this with one person in your life who's paying off debt as fast as they can without asking why, because the answer to that question might change everything for them. And if you want to take this architecture one level further, the next video covers private family banking structures, how to become your own lender, fund your own investments, and build a generational moat that operates entirely outside the conventional system. That is the logical next layer. It's already up. Build the moat. Control the architecture. See you in the next one.